Hi, everybody. This is Uncle Gary again. And in this episode, we're going to cover off three important topics. The first one, I got a lot of questions on picking or finding stocks that will suit your investment objectives to put into your portfolio. So I'm going to be answering that question. The second one I'm going to be answering is how to know when to get in or get out of a stock. It's really important to know what signals you want to be looking for that would match your own investing style or your own portfolio. The third one I'm going to mention is a little bit on how to make sure you don't lose your money. None of this is trading advice, and this is just for educational purposes. And with that being said, I think it's always worthwhile understanding how to make sure you don't get wiped out. If you are going to be playing in the stock market, it's a very, very specific type of skill set required to do that. So I'm going to show you a few little tricks about how to avoid getting totally wiped out in the market. So with that, let's jump right in. So when you're looking at picking some stocks, you get to bear in mind that depending on what your specific portfolio requirements are or whatever your specific investment objectives are, that will indicate a lot about what you're going to use to weight which stock and which type of stock you want to purchase. So there are a lot of criteria or investment circumstances, I suppose is the best way to put it, that would influence what or why you would be purchasing a stock. There is no right answer, and there's no just one stock that's just going to go up. I only want to buy the ones that go up. There's going to be a little bit more thought involved in purchasing or picking a stock. So let's go ahead and jump right in, and I'm going to first call up our very first website that we're going to look at. This is known as Finviz, so I'm going to go to finviz.com, and when we get to the Finviz website, it's going to show you a list of a few things, and you can go ahead and look around the screen. It's got a list of the top gainers, the new highs, anything that's overbought. If anyone's been insider buying, that means directors or officials of a company buying the company's own stock. It's usually quite a good sign. There's a list over here of some of the biggest losers, the top losers for the day, new lows, most volatiles, if anyone's been downgraded by one of the rating agencies. Useful to know as well. And then there's a little block diagram that shows you if the stocks have been moving up or down inside their sector. So we'll come back to sector in a moment. But the key here is I like to use Finviz to go to this screener. So if you click over here in the top left, third from the left is the screener. And what the screener allows me to do is gives me about 17 drop-down boxes that can filter what stocks are going to suit my particular criteria. So what I'll show you here is there are right now a total on the screen of 7,549 stocks. And we're going to start off by saying that I'm generally looking for a company, and I'm just fictitiously making this up. This isn't trading advice. I'm not going to give you a specific recommendation because I don't know what your investment objectives may be. So I'm just going to make up a random criteria, and all of this is just entertainment and education purposes. These are not recommendations, so please make sure you do your own research. Make sure you contact your own financial advisor. Do not take what I say as a recommendation of any sort. For the sake of this conversation, let's talk about market cap and say that I generally like, something that's a little bit larger. So a good mid-sized company, which is over 2 billion, all the way up to the very largest of the large, the Apples and the Teslas and the very large. So I'm going to go and click on 2 billion, and above. And it now has reduced our stock listings now down to about 1,800 or 1,983 to be exact. So those are visible here. And the next thing I'm going to do is select volume. Volume is a key one. Volume is the amount of stock or shares that are traded each day. And this is an average volume. Now, many people forget that in order to sell your stock, when you do want to take profits, it's critical to have a buyer. And that may sound like a really obvious thing to say, but most people don't realize that unless there is a buyer on the other side of your trade, you can't sell that stock, no matter what the price says on the market. If no one is there to buy it, you're just dreaming about selling it at that point. And most people only trade the very large stocks, so they don't realize there are many stocks that are not highly traded. The stock could be very tightly held and very illiquid, so it won't move much. And that could mean that you can't get rid of that stock if you want to. And it may be that the stock price has to go really way down before someone will be willing to buy it from you. So I like to keep to the very highly traded stocks as a personal preference for when I'm trying to look for stocks for my portfolio, because I want to know I can sell them if need be. So I picked over 300,000, and that's brought our stock numbers down to about 1,600 stock listings. And I'm also even going to double down on that one and say, even so, I still want to make sure that at least the current volume is trading at or above the market. So even the current volume, that's today's volume, is kind of at the 300,000 shares mark or above. So that brings us down to now 900 shares. So nothing that's strangely under traded today is now what we've selected. The next piece I'm going to tell you about is sector. Now, sector is a recommendation for trading inside an area or an industry you know about. And what I mean by that is a lot of people think I'm just going to get some great stock tip and I'm just going to go and find the stock, look at the screen, and then buy it. Well, that may not be a great idea if you don't understand the industry or the stock that you're buying, because you may get the stock tip, but you won't know necessarily if something happens in that industry, you won't recognize what is an important and what's not an important signal. Whereas if you trade inside an industry you know, you would recognize something important happens. So if you're going to buy, let's say, silver, and you know nothing about silver or platinum, if you don't know anything about silver mines, platinum mines, or just the trading of commodities and metals, you would not recognize if something serious happened or if a good buy signal showed up. So generally, you want to stick to things you actually understand. So I tend to like technology stocks, financial stocks. I'm in general a fan of those two because I understand them well, not because they're any better than anything else, but I understand what I'm looking at and I'm able to detect from having traded them for many, many years. This brings us now down to about 169 stocks. I'm going to bring the country to the USA. In case you have a dollar-denominated tax-free savings account or a Roth IRA you're trading in, whatever your way of trading, whether it's a registered 401k account or whether it's a registered retirement savings plan in Canada or a tax-free savings account even, you can denominate that in US dollars or have some denominated in US dollars and trade this way. So this brings us now to about 138 stocks. If you see over here, just going to highlight that area of 138, and you can see all of these stocks that would fit whatever I've dropped down. And you can go in and play with these and pick whatever other things you want to know. If let's say you only like stocks between $10 and $50 as an example, so you can go ahead and filter further down, and that'll bring your stock number down to about 60. And that's a fair amount to start looking through the ones that you think are either overvalued, undervalued, whatever you're trying to do. I then like to go ahead and click on charts. I like some things about what Finviz does with its charting, but there's some things I don't like. So I'm going to show you a different charting platform in a moment, and then we'll carry on from there. So let's switch over to that one. On the next one, which is TradingView, TradingView.com. So TradingView is a graphing tool and a viewing tool for all sorts of different type of stock trading information. Again, there are many things I like about TradingView, and I like their stock trading charting module. So I'm going to show you that. Both Finviz and TradingView are free. You can use them. There's no requirement to register and pay for anything. If you do want more advanced features, you can go ahead and register and pay, and then you can sign up and do whatever you want with them. But the foundational modules are everything that I'm showing here. Should be available to you for free. You can go ahead and find the links to both of these down below if you do want to register and just use the free modules. It's worthwhile using that. So when you go to Finviz, you'll notice there are a couple of things. It'll give you a market summary. You can click on whether you want to look at indices or these currencies, futures, crypto, bonds. There's a whole lot of things that you can look at. It'll give you what the editors are saying you should be looking at. It'll tell you what stocks are gaining or losing, calendar of events, and so on. But the module that I'm going to go to first off is the charting module. So I'm going to go ahead and click on this charting module. And when you get to a chart, it's going to show you an empty screen. I've created a list of stocks that I'm going to use just as examples here. Some of the more common and frequently traded stocks. So let's go ahead and have a look. Here we are in Anheuser-Busch. This is Budweiser, and their stock is Bud, B-U-D. So what it's showing you here are a couple of things. I'm going to actually, let me just take it and put it the way it will probably show up for you the moment you come here for the first time. So it's going to show you these little green and red specks on the screen. And what I'll do is I'll just zoom in on this timeline. I'm going to drag the dates to actually make these a little bit bigger, and I'm going to make them a little bit more visible on the screen over here. Now, these are known as candles, and they're a way of depicting where the market moved. If that's not familiar, I'll go through this quickly. If it is, you can jump ahead 10 or 20 seconds. Now, a candle is essentially showing two things. This big block piece over here, and then the little hairs on the top, or what are known as the wicks. And these can be above or below. These are both known as wicks on the candle, as you would imagine with a traditional candle. Now, if a candle is red, it means that it started at the top over here and it went down and closed at this price over here. The little wick is if the stock price moved even further, but it came back up to close over here. This bottom of the big block, or the body of the candle, is where the stock price closed. And the opposite is true for a green candle. If the green candle is green, it's because it opened at this very bottom of the body, and then it went up and may have gone up with a wick, but where it closed is the top of this candle body. So the body is the open and the close. If it's green, the one is above the other. If it's red, the other one, the closing price is below the opening price. So that's essentially why we use candles. Very quickly, you can just look at the screen and tell clearly that was a down day, this is an up day, down, 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 up, so on and so on. So you can start to see things moving around. One key point here, I've chosen this D over here. If you drop this box down, you can choose over what period you want to look at these stocks. So in this particular case, I'm looking at it on the daily, which means what was the price at the beginning of the day versus the end of the day. You could trade on the 1 hour. If you wanted to look at stocks hourly for some reason, you could do that, or you could look at them weekly. If I went to weekly, it would show me this, which is over the week, how the stock has performed versus over the day. I generally trade on the daily, so this is what it would look like for me. Now, I'm going to add a couple of things that will help you pick when and how to get into a stock. Because now let's say we're going back into our stocks. I'm going to give you an example of a stock that we saw. One that looks quite interesting is maybe Box. And we can go ahead and look at what it's been doing. And you can see it's been on an interesting rise. It gapped down quite a lot here. And that was what I was telling you a little moment ago about if there's no one to buy the stock at the price you think it's at. You think you're going to get out here at $18.50, but when the market then opens up the next day, you're at $16.93 before anyone's willing to buy. This is known as gapping down. That is a difficult situation because you think you've made, X many percent, and then by the time you actually choose to exit the stock, you've already lost that margin or whatever you thought you were going to make. So that's something to watch for. You can add the volume, and that was that 300,000 that I was talking about on the previous screen on Finviz. These are each bars showing how much volume and whether the market ended up or down. So they've just taken the color scheme from the candles above and superimposed it over these bars of volume. So you can actually see whether the stock is trading highly traded on this day. You can see it gap down and everyone wanted to get rid of that stock that day. And then as it started to move here, everyone was really buying it. Then you can see these are quieter days over here and here. So you can start to get a sense of what the volume of the stock is telling you. That's an important point. If there's nobody buying the stock like here, then it's an illiquid day. It might not be a very active day for your stock or whatever you're trying to do. So something to take into account. The next thing that I'm going to encourage you to add is I'm going to ask you to add, if you click on this FX button, I'm going to ask you to go to the built-ins and we can search for the MACD. And we can go to the MACD. And what that shows me is another little graph over here. I'm just going to drag this down so that I can see it a little bit more clearly. And what this shows you is the MACD is known as an oscillator. And that means it bounces up and down between green and red. If I move the whole graph and look over a longer period of time, you'll see it goes red to green, lighter green to red, lighter red to green, green, red, and so on. And it oscillates, and it will have these little bars underneath there, as well as these two lines, a red line and a blue line in the TradingView system. Now, when these lines cross over, that's an important event. So you want to look for that crossing of those two lines. And I can make this a little bit larger so you can see it. Here, there's a cross. There's a cross. And you'll notice when the line crosses, the blue goes above the red, it starts to signal that it's a good time to start considering buying a stock. And when the line crosses, blue crosses below the red, it's probably a time to get out of the stock. Now, what I'm telling you here is essentially a form of swing trading, which is basically buying when a stock goes up and the moment it starts to go down, selling it. This is not long-term buy and hold type investing. So if you're looking to do buy and hold, don't worry about the MACD. It's not that important unless you're trying to find out when the right time to enter the market is. You probably want to enter on the way up or not on the way down. So that's an important point about the MACD. The next thing I'm going to click on is this little FX. and I'm going to go to the built-ins, and I'm going to now choose RSI. RSI is the relative strength index, and I'm going to click on that one. You'll see it'll add RSI over there, and it's now added another graph over here. So there's 3 graphs on the screen: the actual stock price, the MACD, which you're just using to look for when these lines cross, and I'll actually show you a little bit more about what that looks like, and then the RSI. So if we look at what the MACD does, I'm going to just expand out a little bit, and we see that it crossed over here. When you see a cross happening, the stock starts rising, and you can see it went up over here and started going up, and then it started tailing off, and the stock crossed, and then it started moving down quite aggressively. So you want to watch for that. The moment it crosses there, there's a good chance it's going to start falling, and you want to either get out of the stock or just expect that you're going to be holding it if you choose to hold it while it's going down. I'm not a proponent of holding it in this kind of market, because I think, there's no reason to romanticize the stock. I prefer to buy stocks that go up, and if they look like they're going to go down, I sell them. But that's a personal choice about a very specific piece of my portfolio. So you got to do what works for you and not take what I'm saying as a recommendation. Again, when the stock crossed over here, you can start to see it started to trend up and went up from there. It then crossed. You saw it drop down. And so you can start to see over a period of time what you're looking at here. Now, this over here is known as the RSI, or the relative strength indicator. And what that is showing you is essentially on a scale of 0 to 100, it's showing you whether a stock is trading above or doing something unusual for its amount of volume. And it uses 2 terms that you may come across, one known as overbought and the other one known as oversold. And what it means is if something is overbought, a lot of people have been very interested in buying the stock, and that's probably an indication that there may be a pullback. People may get a little exhausted with that and need to sell or not be that interested. We've sucked up all of the demand for a stock. And then oversold is a lot of people have dumped the stock or sold it, and there may actually be not that many other people who are willing to sell, in which case things are going to start to move back up. So you can start to look at that. This system over here in TradingView actually puts these 2 bars at 70 and 30. Those are where the RSI is going to oscillate in between. If it's in the middle of this purple, it basically doesn't mean there's anything noteworthy happening. The moment it touches or crosses over, as you can see here, there's a cross above the 70 on the RSI. That means it is overbought. Above 70 on the RSI is technically overbought territory. That means you probably don't want to get in right at this moment until it comes back down. A colleague of mine takes a far more simplistic approach and just says anytime the stock drops below the 30, I'm going to consider buying a stock that I like because it's oversold. More people have sold it than probably usually do, and so there's going to be a whole lot of people who got out and they'll want to come back in at some point. As you can see here, it was well oversold, and I'll just pick up the graph so you can actually see what happened. That was in the March crash, and it was oversold. Everyone wanted to get out of the stock, and then gradually it started to come back. So if you bought here, it would have come back. If you bought here, it would have come back. So the RSI is a really, really interesting and useful indicator to see if it's the right time to get into a stock. There's no right or wrong answer, again, depending on what you're trying to do. If you're diversifying your portfolio or rebalancing, you may get into the stock even if it is overbought. It depends on what you're trying to do, but I generally like to buy stocks when they're lower and then sell them again when they're higher. I don't romanticize a particular trade. So that's what I wanted to show you there. The only other thing that I did want to show you is you can change the type of candles if you're looking for a trend. And I mentioned to you that trend is your friend until the end. What you may want to try here is click on this candle button, and you can try looking at what are called the Heikin Ashi candles. And that basically simplifies candles to show you a trend if something is occurring in a specific way. So this will color them in one color until something changes on the MACD, and it will then show you that there's a trend going in a different direction. So here they're all red. You can see the trend, and then you can see it started to move up. Then it started to crash a little bit, and then it started to move up a little again. There was a pullback here, and it started to move up again. So you can kind of get a sense using the Heikin Ashi candles that it's easier to read. If you're starting out and you haven't used candles, this is a really much easier way to view a trend, to see that we're kind of in red territory as of today, but generally speaking, we've been on the rise. So we could still see that moving up. And if we go and choose any other stock, let's say we wanted to go and choose, we were on Bud a little while ago. Where's Budweiser, there it is. If we go and look at Budweiser, you can kind of see there's been an upward trend, down, up, down, up, down, up, down. So there's been a little bit of choppiness, but that's essentially why you would use Heikin-Ashi candles. I'm going to go ahead and switch back to the traditional candles. It's a little bit harder to read what's going on, but the Heikin-Ashi candles lengthen everything so that they follow a trend, and it makes it a little bit easier to read. So that's what I wanted to show you about that. The last piece that I'm going to tell you is if you are interested in trading, if you're in the US, you can go ahead and sign up here with Webull. They give you some free stocks if you sign up. I'm not in the US, so I'm not eligible to trade with Webull, but they are a recommended and very interesting trading platform. They allow you to trade after hours, which is very useful. And the other one that if you're in Canada and you're interested in trying out a trading platform, I find Questrade quite an interesting platform. I've traded on many of the Canadian platforms and I have accounts with many of them. But there are a few things Questrade does that I find noteworthy. The one is that it allows you to bring your family into a group, or even very close friends if you know them well enough. You can bring your relatives' accounts into a grouping and then save on fees. So they charge you generally $4.95, where many of the other banks and the main street brokers charge you $9.95. And in addition to that, they will give you this ability to group your accounts together. That's quite an unusual offering, pretty progressive, and they too have a very powerful interface, and you can do a lot with that. So what I want to communicate is use a trailing stop loss, and that is a type of sell order. And what that means is when you're selling a stock, you can choose to sell it based on if it goes down a certain percentage, then exit the stock, and you can automatically have that trade captured for you. So when you purchase a stock, the moment you purchased it and you know that the stock is now in your account, you can immediately put in a sell order that does not trigger yet. So a trailing stop loss is a sell order that will lag behind your stock price of your stock until it meets a certain condition. So let's say we were going to buy Budweiser as our example over here in TradingView. If I bought the stock over here and I said that, I want to put a 20% or even a 10% or a 5% trailing stop loss, it will allow me to take the rise in the stock, but the moment the stock drops 5%, or if I put in a 7% trailing stop loss, if it drops 7%, sell the stock. And that does that automatically without you having to be on the markets looking at them every minute of every day. The reason I'm telling you this is what will prevent you from being totally wiped out. Far easier taking a 5 or 7% hit on a stock. If you lose that amount, it's far better than having the stock go down 30, 40, 50% and not being able to get your money back until the stock comes back to that previous level. As you may have seen, there have been times in the past where a big pullback happens and then people are left holding the bags and aren't able to exit the stock without taking a big loss. So having a trailing stop loss makes sure that as the stock price goes up, the amount behind it is always maintained for you as a buffer. So if the stock goes up 20%, the moment it drops from that 20% down 4% from that point, it will sell out, or 5%, whatever your trailing stop loss. Very, very worthwhile strategy. Keep your stop losses tight. You don't have to use a trailing stop loss. You can just choose a different type of stop loss, which is to say if it hits a specific number, not a percent. If you bought the stock at 100 and it goes up to 120 and you want to get out if it drops to 105 so that you've at least made 5%, you can go ahead and put in a limit order and just say that it's a stop loss to say at 105, sell my stock. So that is also an option, but have your stop losses. Do not allow your stocks to sit unguarded or unprotected. Keep a guardrail around your holdings so that you don't get wiped out. So in this video, what we went through was 1, how to know what kind of stocks will suit your particular portfolio or profile preferences. 2, how to make sure you know when a good time to get into a stock is versus a good time to get out of a stock. And 3, always keeping a tight stop loss or a trading loss prevention so that if you are going to take any knocks, you're able to limit how much damage they do, and you're able to at least maintain your investment successfully. And especially at times like these where there may be some volatility in the markets. If you haven't seen the video that I mentioned before, go ahead and have a look. There should be a bubble that will pop up and you can go ahead and watch some of the things that may be coming that will require keeping a stop loss for your own safety. So with that, thank you very much for watching. Please go ahead, like and subscribe, and click the little bell icon below so that you hear about more videos from Uncle Gary. And if this was of value, my invitation is please share it with someone that you think would benefit from this. If you know someone that's interested in the stock market, or you know someone that you like to talk about stocks with, or even someone that you think would just benefit from it because they haven't had exposure to it. That's really why I do this, is just to share that people get a chance at being successful. So thank you very much for watching, and I look forward to seeing you on the next one.